Good morning, friends. Just to introduce myself, I'm Amit Jain. Today we have a session on Ind AS 113, which is a fair valuation. Right. So before starting this standard, let's understand the fair valuation concept and let's understand, do we have the concept of fair valuation under Indian GAAP? So what is fair valuation? Fair valuation is nothing but basically a market price. That means if I'm entering into any transaction which is based on the fair valuation. So fair valuation is nothing but a market price. So we need to understand in this standard what is the market price in respect of dealing with certain transaction, right? So in India there are various standard which requires that the transaction or the accounting needs to be done at fair valuation, right? So what is the fair valuation we are going to understand in this standard Ind AS 113, right? So for the in respect of having a basic understanding of the fair valuation is nothing but a market price, right? So in the standard we will study what are the different techniques of fair valuation and where is the appropriate requirement which is required by the different standard where the fair valuation is required, right? So before moving to Ind AS 113, let's understand about Indian GAAP, whether Indian GAAP also talks about fair valuation concept or not. So largely we all know that the Indian GAAP talks about the historical concept, historical cost concept, and Ind AS is based on the premise of the fair valuation. IFRS and US GAAP are also based on the premise of the fair valuation. But let's understand under Indian GAAP that is there any standard which talks about fair valuation? So if I talk about AS2, if I talk about AS2, which is a valuation, which is a inventory valuation standard. So AS2 says cost or NRV, whichever is lower. That means when I'm valuing my inventory, I need to evaluate or I need to compare the cost of the inventory with the fair valuation with the net realizable value, right? So whichever is lower on that premise, I need to value my inventory. So that means under Indian GAAP, we have AS2, which talks about the fair market valuation, which talks about the NRV net realizable value, right? Apart from AS2, we have AS9. AS9 talks about revenue. In that particular standard, if there is any barter transaction, right? So whatever I have received, whatever the company has received in exchange of the transaction, in case of the barter transaction, that will recognize at fair value of the goods and services received, right? Um, so AS9 also talks about the fair valuation in case of barter transaction. AS10, which has been revised from 1st April 2016 and which has been equivalent to Ind AS 16. So AS10 also says that if there is a deferred consideration, in that case the PP shall be recognized at fair value. And prior to new revised AS10, we were having old AS10. That old AS10 talks us about in respect of the exchange of PP, right? In that case, we recognize the PP at fair valuation of the PP of the consideration received or receivable, right? So old AS10 as well as the new AS10 talks us about fair valuation concept, right? If I talk about AS11, foreign exchange, in case of the foreign exchange, monetary asset and liabilities need to be restated as at year end or the reporting date, and the change will be recognized through PNL, right? So that means AS11 also talks us about fair valuation concept. Then we have AS13, investment cost or market price, whichever is lower. So that means AS11 AS13 also talks about fair valuation concept. Then we have AS14, amalgamation. If there is amalgamation in the nature of purchase, then I need to record my asset and liability at fair value. So that means AS14 also talks us about fair valuation concept. Then we have AS15, actuarial valuation. Employee benefits, in case of employee benefits, we need to get the actuarial valuation done for gratuity and leave encashment. So that means what the actuary does, it applies a project credit unit method, it applies the income approach discounted cash flow technique to compute the fair valuation of the gratuity and leave encashment. That means AS15 also talks us about in respect of the fair valuation. Then we have AS17 leases, where the lease value should be computed at the present value of the future minimum lease payment in the books of lessor, right? So AS17 also talks us about in respect of fair valuation. Then we have AS28, that means impairment. In that standard, we have to compute the fair valuation of asset, value in use, right? Value in use or fair valuation of the asset, fair value less cost to sell. That means AS 28 also tells us about in respect of the fair valuation concept. So it is not the case that the Indian GAAP does not talks us about fair valuation. Indian GAAP under various standard under Indian GAAP, we have the concept of the fair valuation, right? So that means it is not a new standard which we are reading today. It is the same concept which we have also read under Indian GAAP. But under Indian GAAP, what has happened? There is no standard, there is no specific standard which talks about fair valuation. That means in the respective standard, it talks about the concept of the fair valuation, like inventory, like revenue, like foreign currency translation, right? Foreign currency, investments, actuarial valuation, PPE, lease, impairment. So these are the various standard which talks us about concept of fair valuation under Indian GAAP. Right, so this brief background, let's start the standard of Ind AS 113. But under Ind AS we have a separate standard which talks about the fair valuation. So this standard only provides the guidance that how to compute the fair valuation, but this standard does not provide the guidance when fair valuation is required. So we need to study, we need to go through other standard which provides us the guidance when the fair valuation is required. So when answer of when will be given by other standard, and how to compute, that is the answer of how to compute the fair valuation is given by Ind AS 113. So let's study the standard. So what we are going to discuss, we are going to discuss the overview of Ind AS 113. Then we discuss certain definition and the key concept of 113. Then we will discuss how to apply the fair valuation concept in practice. After that, we will discuss the fair valuation significance under different standard, disclosure requirement, key challenges, and the difference between Ind AS versus Indian GAAP on account of fair valuation. Right. So let's talk us about in respect of the overview of Ind AS 113. So first thing is, what is fair value? What is fair value? Fair value, we all know that it is a market price. So let's understand what is the market price, what is the guidance given under Ind AS 113 in respect of the fair valuation. So Ind AS 113 says the fair value is an exit price. What is an exit price? Exit price means that that by entering into the transaction, that how I can exit from that particular transaction. That means if I am already having an asset, by selling an asset, whatever price I will get, that is a fair market value. If I am having a liability, what price I need to pay in order to transfer that liability is a fair value. So standard says, what is a fair value? Fair value is an exit price. That means you are exiting a transaction. You are exiting from a particular transaction. Fair value is an exit price, is an orderly transaction between the market participant at the measurement date. That means fair value is an exit price. That means the price you will get by selling an asset, the price you have to give or you have to transfer for transferring a liability or for assuming a liability, right? In an orderly transaction between the market participant. What is market participant? Market participant means the market people, the buyer and the seller. That means these are not related party, right? Those market participants must be knowledgeable. Those market participants are not a related party. They have a reasonable mindset and they want to enter into a transaction. That is what the market participant is. And at the measurement date, so on the date of recognition of a transaction, what is the market price which has been entered between the market participant in an orderly transaction? So it should not be a structured transaction. In an orderly transaction, that is called fair value. So in a nutshell, fair value is nothing but a market price at which the reasonable people, which are not which are related, which are unrelated party, they can enter into a transaction, right? And which have reasonable mindset to enter into the transaction, and they are willing to enter into the transaction. That is what the fair valuation concept is. Right, guys? So this standard Ind AS 113 does not prescribe when to measure the fair valuation, because that guidance has been given by other standard. This only provides the guidance on how to measure the fair valuation when required or permitted by the different accounting standard. Right? It provides the guidance how to compute. Different methodology has been provided by Ind AS 113 how to compute the fair valuation. right? While computing and doing the computation of fair valuation, the cost to be incurred in respect of the transaction cost, in respect of the incremental cost, that shall not be taken into consideration while computing the fair valuation. What is transaction cost? Transaction cost is like a brokerage cost, incremental cost, like if I need to pay the stamp duty, that shall not be taken into consideration, right? So the transaction cost shall not be considered for the purpose of valuation of fair value. Scope of Ind AS 113. So what is the scope? It will include the fair valuation measurement, both the assets and liabilities, both financial and non-financial, own equity instrument, all those shall be considered for the applicability of Ind AS 113. But there are certain things which have been excluded from Ind AS 113 scope. What are those items? Ind AS 102 share-based payment that have been excluded. Why that has been excluded? Because it has been captured under Ind AS 102 itself. Ind AS 116 lease accounting that have been excluded because Ind AS 116 provide the guidance how to compute the fair valuation. Ind AS 2 inventory cost on NRV, whichever is lower. How to compute NRV? The guidance is given under Ind AS 2 only. Ind AS 36 impairment, how to compute the value in use, that is given under Ind AS 36, and hence these standard or these guidance have been excluded from the scope of Ind AS 113. Okay guys, let's move on to understand key concept or the key definition for Ind AS 113. First is active market. What is active market? A market in which the transaction for the assets or liability takes place with a sufficient frequency and volume to provide the pricing information on an ongoing basis. That is an active market. That means the market in which the transaction happens on an sufficient frequency and with the sufficient volume. For example, NSE, BSE. So these are the markets in which transaction happens with a sufficient frequency and volume. Entry price. What is an entry price? The entry price is basically the price to be paid to acquire an asset or received to assume a liability in an exchange transaction, right? So if I paid any price to purchase an asset, that is the entry price. If I have received any price to assume a liability, that is called a entry price. But what is an exit price? Exit price means the price I will get by selling an asset, the price I need to give for transferring a liability, that is an exit price. So what is the difference? So what is fair market value? Fair market value is nothing but an entry price. The fair market value means the exit price, right? So whatever amount I need to receive for selling an asset, whatever amount I need to pay for transferring a liability, that is a exit price. Right guys, then we have the principal market. What is principal market? The market with the greatest volume and the level of activity for the asset or the liability. So that means, let's say there is NSE and BSE, right? And I need to compute the value of the equity shares of a listed company, right? So should I go with the NSE or should I go with the BSE? So it will say I need to consider the principal market. So what is the principal market in that case? The principal market is the market having a greatest volume and the level of activity. So I need to evaluate which market has the greatest volume and the level of activity. On the basis of that, I need to first consider which is the principal market for computing the fair valuation of that listed company. Market participant. We have discussed market participant. Market participant means the buyer and seller who are knowledgeable, who are independent of each other, which are not related to each other, and they are able to enter into the transaction for the asset or liability. That means they are willing to enter into the transaction, reasonable mindset. That is called a market participant. After that, we have the most advantageous market, right? Which market provide me the best fair valuation, which is most advantageous to us. I need to evaluate, or a company has to evaluate, which is the most advantageous market. The market that maximize the amount that would be received to sell an asset, or minimize the amount that would be paid to transfer a liability after considering the transaction cost and transportation cost. That is the most advantageous market. So it means the market which maximize the amount which I'm going to receive by selling an asset, and the market which minimize the amount which I'm going to pay to transfer a liability, that is called a most advantageous market. Then we have another definition, highest and the best use. What is highest and best use? The use of a non-financial asset by the market participant that would maximize the value of the asset or the group of assets and liabilities within which the asset would be used. So that means what is the highest and best use? The market participant or the market which will maximize the use of the maximize the value of the asset or the group of assets and liabilities. So the market which will maximize my my fair valuation of the asset, that I will consider for the purpose of fair valuation as per the standard Ind AS 113. So let's understand what is highest and the best use for the non-financial asset. Right, for the non-financial asset is, for example, fixed asset, for example, land, building. So these are the non-financial asset. Right, so let's understand this. Market participants ability to generate the economic benefit by using that assets in its highest and the best use. Highest and the best use, consider the various parameter. For example, physically possible. That means if I am doing the valuation of a land, right, so I need to consider, or the valuer has need to consider where the where the property is located, what is the size of the property, which is physically possible. Legally permissible, if there is any legal restriction attached to that property, right, I need to consider for the purpose of the valuation what are the different legal restrictions attached to that property. Financially feasible, right, financially feasible means asset will be able to generate the adequate return, right. So these are the three parameters which the valuer has to consider or the organization has to consider for the purpose of doing the fair valuation under Ind AS 113, which is financially possible, physically possible, legally permissible, and financially feasible. Right, it can be determined. So highest and the best possible use of the asset can be determined on a standalone basis or in the combination of the other assets and liabilities. Right, so for example, if I need to value the other assets and liabilities including that particular land which is constructed on that property, so it may possible that a valuer compute the fair valuation of the entire property including land. Right, so the highest and the best possible use shall be considered either on the standalone basis or on the combination with any other assets and liabilities. Right, okay, so in respect of the fair valuation measurement, so standard provides us the guidance that while measuring the fair valuation, the transaction cost shall not be taken into consideration. So if you look at my PPT, the transaction cost shall not be taken into consideration for the purpose of fair valuation. But if there is any transportation cost, if the valuer has to move from one place to another place in order to doing the fair valuation, so those kind of cost, which is a transportation cost, that shall be taken into consideration while doing the fair valuation as per Ind AS 113. Right, guys? Then we need to consider the most advantageous market. We need to evaluate which is the most advantageous market for doing the fair valuation. Right, most advantageous market needs to be identified for computing the fair valuation. Right, and while determining the most advantageous market, transportation cost as well as the transaction cost as well as the transportation cost shall both need to consider while evaluating the most advantageous market. But while evaluating the fair valuation, transaction cost shall not be taken into consideration, only the transportation cost shall be taken into consideration. So if you look at this example which is given on my slide deck, right, so this is market A, market B, and market C. There are various transactions which have been mentioned here, like annual volume, transaction per month, price, transportation cost, quoted value, transaction cost, and the net proceed. Right, so this is the quoted price minus transaction cost is equal to net proceed. Right, this is for market A, market B, and market C. Now, which is the principal market in this case? Right, what is the principal market? Principal market means what we have read just a couple of minutes back. Principal market means the greatest volume and the level of activity. That is a principal market. So if I look at which is the principal market, market A is saying annual volume is 30,000. Market B is saying 12,000 is the annual transaction. Market C is saying 6,000 is the annual transaction. So which is the principal market? Principal market is market A, because the market A is having the maximum annual volume. And what is the fair value of market A? Fair value of market A is 47 and not 46, because the transaction cost shall not be taken into consideration. So the fair valuation is 47, right? What is most advantageous market which will maximize the value, right? Most advantageous market is 49, which is market C, because this will maximize the volume. So there are two things. One is the principal market and one is the most advantageous market. So the fair valuation of the principal market is 47 and the fair valuation of the most advantageous market is 49. Right, guys? So these are the different methods. These are the different concept of principal market, most advantageous market, transaction cost, transportation cost, right? I hope this is clear to all of you. Let's move on to understand the valuation technique, which is a critical aspect of Ind AS 113, right? So what are the different approaches which is given by Ind AS 113? There are three approaches. One is the market approach, second one is the cost approach, and the third one is the income approach, right? So let's move and understand the market approach. So what is market approach? So market approach is a valuation technique that uses the price and other relevant information generated by the market transaction, right? So market approach is nothing but a market price. That means where the valuer has to obtain the market price of a particular transaction, whether it is for an shares, whether it is for a asset or liability, right? So market approach is nothing but a market price. That means the price to be taken from the market, right? There are the different approaches. What are the different techniques within the market approach? Market price method, right? Comparable companies multiple, comparable transaction multiples. What is market price method? Where the price has been taken from the market. For example, if I need to value a land, right? So I need to consider what is the price which is going in the particular market, particular locality, whether any restrictions have been attached to that. By considering all those factors, I need to determine what is the value of that plot, what is the value of that floor which is going on in the market, right? What is the value of the floor which has been recently which have been recently transacted in couple of days, in the previous 1 month, in the past 6 months. All those factors needs to be considered while determining the market price. Comparable companies multiple. So it is a benchmarking analysis. That means in a particular geography, in a particular space, in a particular industry, what is a comparable companies multiple? For example, EBITDA of a IT company, right? So if you remember, or if you have studied in respect to the TP section 92 of transfer pricing, of section 92 of the income tax act, which is transfer pricing. So they also have a similar kind of approach where they take the multiple of that industry, where the assessing officer do the assessment on the basis of the multiple, or assessment of the companies based on the multiple of that industry. So that is a comparable companies multiple, right? That means EBITDA, right? EBITDA of that particular industry, EBITDA of that particular industry, uh, price earning ratio of that particular industry. So those are the different bases of doing the fair valuation of a particular item or a transaction. Similarly, the comparable transaction multiple, right? So these are the different techniques which have been given under Ind AS 113, right? So where the market approach is to be used. So market approach is to be used in the equity securities. If I need to do the fair valuation of the equity securities which have the quoted price in the exchange market, then I will use the market approach. In case of the real estate, that means land, building, right? In respect of the real estate, market approach is to be generally used. Investment property. What is investment property? Where the property has been held for the purpose of capital appreciation or rental purpose. That is what the investment property is. And if the valuer has to do the fair valuation of investment property, market approach is more suitable. So which approach is more suitable? So valuer has to determine the limitation and the pros and cons of each of the approaches, and basis that, whatever the best suited approach, the valuer has to determine and mention in its report which is the best suited approach in this particular transaction. If I need to do the fair valuation of the land and building, market approach is more suitable. Okay, guys. So this is about market approach. If I talk about the cost approach, what is cost approach? Cost approach is nothing but a current replacement cost, right? So it is generally used where in case of the tangible asset like plant and property, right? So what is cost approach? Cost approach is that, suppose if there is any problem in the plant in respect of any particular spare part. right? So what is cost approach? So at what price I will get that spare parts today, right, to fit into that machine? That is what the replacement cost, that is what the cost is, right? So valuation technique that reflects the amount that would be required currently to replace the service capacity of an asset, right? That is what the cost approach is. So it is a replacement cost. It is generally used in case of fair valuation of a tangible asset like plant, property, and equipment. Let's understand this example. If company A has to determine the fair valuation of its factory machinery using this approach, the fair value would be the cost that would be incurred by company A to replace the machine on the date of valuation, right? To replace a particular part, to replace a particular machine on the date of valuation. So that cost becomes the fair value. That cost becomes a fair value. That cost is also called the current replacement cost. So this is the second technique of Ind AS 113, right? The third approach is the income approach. What is income approach? We all know income approach is nothing but a discounted cash flow technique where the valuer has to consider the various assumptions, that what is the future cash flows of the company, what is the discount rate, right? What is the terminal value, what are the what are the present value factor need to be considered in order to compute the discounted cash flow technique, or in order to compute the fair valuation. So that is what the income approach is. So income approach is generally used in case of fair valuation or doing the fair valuation of the businesses, in doing the fair valuation of the financial instrument which is not actively traded in the market. So what can be the example of financial instrument? For example, security deposit. Suppose company A has given a security deposit to the lessor for obtaining the premises on rent to operate his office, right? That security deposit is not tradable in the market, right? That security deposit is to be refunded by the lessor after the expiry of lease period, right? So that security deposit needs to be recognized at fair value on the transaction date as per Ind AS 109. And how to compute the fair valuation? In that case, the valuer has to apply, or the company has to apply, income approach as per Ind AS 113 and compute the fair value of that security deposits, right? Liabilities, intangibles, if the valuer has to compute or the company has to compute, then the company has to apply income approach. So which technique is more suitable? So in order to evaluate a particular transaction, in order to evaluate the fair valuation of a particular transaction, company has to evaluate which approach is more suitable, what are the limitation in respect of applying a particular approach, what are the pros and cons of applying which approach to a particular transaction. All those factors, all those assumptions, all those limitations need to be considered in order to evaluate which approach is a more suited approach in a particular transaction, right guys? So these are about the different understanding of the approaches given under Ind AS 113. So let's understand in respect of other standard where the fair valuation is actually required. Interest-free security deposit. So if I talk about the financial instrument, which is Ind AS 109 and Ind AS 32, right? So as per that standard, all the assets, all the financial assets and liabilities needs to be fair valued, right? So in respect of the interest-free loans and deposit, that needs to be fair valued as per Ind AS 109, right? So generally what we say, it is not a market approach. It should not, the value should not apply, or the company should not apply cost approach. In that case, which is a better suited approach? Income approach, right? Where the company has to determine what is the cash flows in the future, what is the discount rate, and other assumptions, right? On the basis of that, company will compute the fair valuation of the interest free loan or security deposits. Equity instrument, right? So equity instrument, AS Ind AS 109 says that the equity instrument needs to be fair valued on the transaction date, and subsequently it will be recognized at fair value only, either through other comprehensive income, or through FVTPL, or through that means, or through PNL, right? So that means equity instrument will always needs to be fair valued, right? How to compute fair value? That will be given by Ind AS 113, either to apply a market approach or income approach. Compound financial instrument. What is compound financial instrument? The guidance of compound financial instrument have been given by Ind AS 32. It says that for the issuer, it is a financial liability as well as an equity. It's a case of compound financial instrument. The example could be convertible debenture, where the interest payment is mandatory in cash, and where the conversion satisfy fixed to fixed criteria, and therefore it becomes equity in nature. So from the issuer perspective, it is a equity as well as the liability, as well as the financial liability. So it becomes a case of compound financial instrument. So Ind AS 32 says that initially on the transaction date, I need to record, or the company has to record, or company has to compute the fair valuation of the financial liability first, and differential shall be allowed or allocated to equity. Right, equity is the balancing figure. So that means fair valuation needs to be determined for the financial liability. And how to compute the fair valuation of that financial liability, right? So either apply market approach or income approach, but generally income approach is a best suitable approach. Mutual fund, Ind AS 109 says that the mutual fund needs to be recognized at fair value only, right? So how to compute fair value? NAV, which is a market price. So in that case, company will get just a market price from the market participants and recognize at fair value. Next, we have the fair valuation concept in respect of business combination. One is deferred consideration. So what is deferred consideration? If suppose I'm acquiring a business today, but I'm making a payment after 5 years down the line. So as per Ind AS 103, I need to recognize the transaction or the purchase consideration at fair value today. That means I need to compute the present value of the consideration in the future. Right? Which approach? I think income approach is the best suited approach in that case. But again, the valuation shall be required depending upon the transaction. NCI needs to be fair valued. Valuation of the intangible assets. So at the time of business combination, the hidden intangibles need to be identified. For example, customer list. For example, any other item in respect of the intangible. So we need to identify the intangible, for example, customer list, for example, any other item which is not identified, for example, brand, right? And if one company has acquired another company, I need to identify, or the acquirer need to identify the various intangibles assets which have not been recognized by the other company. Right, so there is a specific requirement under business combination under Ind AS 103 that those hidden assets needs to be identified and they will be recognized at fair value. Right, that fair valuation to be carried out as per Ind AS 113. Step acquisition. If I am moving from 40% to a 60% scenario, then I am acquiring a control. In that case, I need to do the fair valuation of my previously held stake of 40%. So that means I need to apply Ind AS 113 for the computation of the fair valuation of the existing held stake. First time adoption, right? That means where the company is going for the first time adoption. Intangible. Ind AS 101 says that the company has an option to do the fair valuation on the transition date. Right, so how to compute the fair valuation as per Ind AS 113. Business combination. Ind AS 101 says that the company has an option to restate all the business combination. What is restatement? That company will recognize all assets and liabilities at fair valuation as per Ind AS 103. Right, so how to compute the fair valuation as per Ind AS 113. Other item, PP. Ind AS 16 permits the revaluation model. Right, that means you can fair value the company can fair value the assets and assets, PP, like PP and all the assets of the PP as per Ind AS 16 if they adopt the revaluation model. How to compute the fair value as per Ind AS 113. Investment property. Disclosure needs to be given in respect of Ind AS 40 in respect of investment property. That means fair valuation needs to be given in the financial statement. Right, how to compute the fair valuation as per Ind AS 113. Revenue. 115 says the revenue is the fair valuation of the consideration received or receivable. Right, the company has to compute the fair valuation. For example, if I have sold the product today and I'm going to receive my amount of revenue after 2 years down the line, right, then that means I need to recognize the revenue at fair value. How to compute the fair value? Standard says 113. Disclosures. Multiple disclosure needs to be made, like level 1, level 2, level 3. What is level 1? Quoted price. If the fair value is to be determined on the basis of the quoted price, then it is a level 1, which is a quoted price. right? What is level 2? Observable input, right? What is level 3? Unobservable input. So what is the example of level 2? For example, interest rate derivatives, right? Derivative, if the company has taken any derivative like forward, future, option, the bank generally provides the fair valuation of that derivative, right? That becomes a level 2. What is level 3? If I have given a security deposit which is to be refundable after 5 years, then I am applying the income approach to compute the fair value. That means there is no comparable information is available. These information are unobservable input basically, right? Those are called level 3. So multiple disclosure needs to be given. The comparison of fair value versus carrying value needs to be given in the financial statement for all the financial assets and liabilities. So you can see my screen where I have given a sample disclosure of comparison of the carrying value with the fair value in respect of financial assets and financial liability. Where the company has taken a level 3 input, which is unobservable input, the company has to give the technique. Which technique? Right? And what are the assumption which the company has taken in order to compute the fair valuation, right? For example, discount rate, for example, weighted average cost of capital, for example, long-term operating margin. So all those information needs to be given only in respect of the unobservable input in case of level 3, right? Apart from this, sensitivity analysis will also needs to be given. What is sensitivity analysis? That if the particular percentage goes ups and down by 5%, by 7%, by 3%, depending upon the company's criteria, then what will be the impact of fair valuation in the company's financial? That needs to be disclosed in the financial statement as per Ind AS, right? What are the key challenges? Let's also understand what are the key challenges of Ind AS 113. Fair valuation is very subjective, right? So fair valuation is very subjective, definitely yes, because the valuer has to consider all the three approaches. Valuer has to consider all the limitation which are available in the particular approach. Valuer has to consider certain assumptions as well. So it's very subjective. Second is cost of the fair valuation. If the company opts for the fair market value on every reporting date, so there are certain exemption also given whether to recognize a particular item at cost or the fair valuation. So if the company opt for the fair valuation, every time the company has to incur a cost in order to get the fair valuation from the market, right? So the company has to consider those factors while adopting any kind of option which is given in the standards. Disclosure impact of the fair valuation. So multiple disclosure needs to be given in the financial statement in respect of fair valuation. Planning structuring of the transaction. So some potential transaction may require additional planning and resource allocation while doing the fair valuation. So all those factors need to be taken into consideration while adopting the concept of fair valuation, or uh, while while adopting any option for the fair valuation given under the Ind AS standards. Now next is the difference between the Ind AS versus Indian GAAP. Okay, scope, Ind AS. So Ind AS 113 provides certain scope, what all assets and liabilities are included under Ind AS 113. But in respect of Indian GAAP, there is no scope because there is no standard, there is no specific standard under Indian GAAP on account of fair valuation. Under Indian GAAP, we have the guidance of fair valuation, but under the respective standards, which we have discussed at the initially when we started this discussion. Definition of fair valuation, we have talked about definition of fair valuation. What is fair valuation? Fair valuation is an exit price entered between market participant, right, in an orderly transaction. That is what a fair valuation, right? What is the value, what is the definition of fair value under Indian GAAP? So Indian GAAP does not define the definition of fair value because there is no specific standard under Indian GAAP, right? Respective standard provides the guidance how to compute the fair valuation. For example, inventory. So AS2 provides the guidance what is NRV, how to compute the NRV, right? Next, we have the classification and disclosure. So multiple disclosure needs to be given in Ind AS principles or Ind AS standards like level 1, level 2, level 3, which is quoted price. Level 2 is observable inputs other than the quoted price, and level 3 is unobservable inputs. But under Indian GAAP, there is no such concept exists. I hope this concept of the fair valuation must be clear to you. Thank you very much, guys.